Hello, everyone, and welcome to Financially Lit Tuesday. Welcome to Sipping Wealth Live, everyone. Welcome back to another Tuesday where I break down tax codes, laws, and also give you some news tips and tricks on how to wealth up. So, this Tuesday, we are going to break down the tax code, just the basics, really help simplify it for you all so that as you're going through this season of filing your returns and filing your taxes, you have a better understanding of how to file your taxes. Hey, hey. Hello. Um, so yes, so I want to make sure that y'all have a better understanding of taxes and the basics and everything. So this live will go over simplified explanations of navigating the tax laws. So the basics and all that good stuff. All right, of course, per usual, if you're tuned in with your girl, drop a hey in the comment section so that I know that you're tuned in with me. And also hit the like and subscribe button on wherever platform you're streaming from. And so make sure that you subscribe to the YouTube channel, Sipping Wealth. And share this live with your friends, families, loved ones, followers, so that they could join this wealth journey with you and get this amazing information. All right, y'all. So let's go ahead and get started. So for starters, I'm going to go ahead and start with the understanding your filing status. So for those, everyone that are filing taxes, you are broken out into specific filing status based on your situation, whether you're single, married, married filing separately, widower, head of household, whichever one you fit into. So this is extremely important. One of the most important things when you're filing your taxes. Hello, y'all. Hey. So when you're filing your taxes, this is important because it's going to determine your tax rate and your deduction. So if you put single and you really should be filing head of household, that's going to determine your standard deduction. That's going to determine, which I'll break down later, that's going to determine which bracket system you're going to actually be taxed at. So you want to make sure that this is absolutely correct. And to correct, if you have to amend your filing status, a lot of the times it does require you to nail in your return sometimes. And also because it wouldn't be able to be accepted electronically. And also what it also ends up doing is taking a lot longer for your return to process. So you want to make sure right at the gate you have the correct filing status. So for my single folks, this is easy because, hey, you are filing by yourself, no dependents. You're not married. This is for my married filing joint versus married filing separate. This is huge with my married individuals. They're always like, I don't know how to file. Maybe your spouse didn't live with you in the home during the year or for the last 6 months. One of the biggest qualifiers for married filing separately is your spouse didn't live with you for the last 6 months of the year. There are other specifications and things like that, but that is one of the huge keys to identifying whether or not you should be filing separately or together. And there are other cases when married filing separately versus married filing joint makes sense. And I highly recommend you sit down with your tax accountant, tax professional to determine whether or not you fit in one of those buckets. All right. The next is your standard deduction versus itemized deduction. So for your standard oh, excuse me, y'all. So your standard deduction is determined by the IRS. This is adjusted based on inflation every year. So the standard deduction rate is not going to be the same every year. It's going to change depending on your filing status. Again, back to that filing status, your age, and whether or not you have a disability like being blind or of a certain age. Those of a certain age and that are blind, even those that are or that are blind or some sort of disability in that sort, do have an additional standard deduction that they get to tap into. So it is important to like I said, back to that filing status, making sure you put it in there. And then if you are filing with someone blind, or if you have one of the qualifying disabilities, making sure that's reflected on your tax return to make sure that you get that additional deduction. All right. And the other one is your itemized deduction. So for the itemized deduction, that makes sense when you have qualifying deductions that are over the standard deduction amount. So if your standard deduction amount is the 14,600, that's the 2024 standard deduction. So you have to have qualifying deductions. That's your charitable contributions, your medical expenses, your property taxes, things like that. That bucket your itemized deductions have to equal higher or be higher than that standard deduction rate. If it's not, then it's not going to make sense. If you're married filing joint, that standard deduction is now $29,200. So if your bucket of expenses is not over that amount, if your property taxes, premiums that you paid, charitable contributions, all that stuff, if that's not higher than that 29,000 standard deduction amount, then again, it doesn't make sense to go ahead and do all the itemized deductions, because you're not over that threshold. Now, one caveat is, a huge caveat: if you are married filing separately and your spouse itemized their tax return, then the other spouse has to itemize as well. So even I know like some married couples, they're maybe going through some like a stage where they're not talking to each other at all, and you don't even know if the other spouse is, what they're filing as. Unfortunately, there has to be some level of communication, because if they end up itemizing their tax return and they end up married filing separately, and then you filed single and you didn't itemize the return, that could cause issues. So making sure that, hey, there's some level of communication. Hey, how are you filing your taxes? Okay, da da da. All right, and then you move accordingly, because again, that can cause delays, can cause issues. So you want to make sure that both spouses are doing itemized deductions. All right, so the standard deduction rate for 2024, like I kind of mentioned before, for my single folks, it is the $14,600. All right, so that means that first $14,600 of your income that you generated for the year, that's not going to be taxed, because that's within the standard deduction amount. All right, so if you only made $14,000 for 2024 and the standard deduction of $14,600, then your tax bill is $0, because there's nothing to tax. Your income is below that standard deduction amount. All right, so for 2023, it was $13,850. So there is that increase, that about $750 increase from 2023. And then for my married filing joint people, it went from $27,700 in 2023, and now for 2024, you're looking at $29,200. And then lastly, for my head of household folk, you're looking at $20,800 for last year, and then $21,900 for this year. So these are your brackets. So whether or not it makes sense, hey, do I take the standard deduction or do I itemize? And also making sure that you understand, hey, that first, if I'm filing head of household, if I have a dependent, that first $21,000 of my income is essentially not being taxed because of my filing status. So when you're doing your W-4 at the beginning of the year, when you do the paperwork for your employer, so that they know how much taxes to take out of your paycheck, you're essentially telling them, hey, I have one dependent, or I have 0 dependents. Hey, I want you to take out this amount of taxes out of my paycheck because I'm filing single. or hey, I'm filing with a dependent head of household, so I meet this sort of standard deduction amount. So with that, because I meet this certain standard deduction amount, I'm not going to be taxed until I hit this number. Okay. All right. Hopefully that makes sense, y'all. All right. Next is our contributions to your retirement account. So contributions to your account, retirement account is great because you actually have until April to continue to put into your retirement plan. So if you're like, yo, I'm going to owe the IRS, you might as well pay your future self and max out your retirement contribution for the year than to send the IRS an additional money. Now it's not, if you max out your retirement, that's $6,500. That's not to say your tax bill is going down by 6,500, but it is to say that, hey, I just took a $6,500 deduction and I don't have to pay taxes on that income. Now if it's a traditional 401k or IRA account. Now, if it's a Roth, then you are going to be taxed because it's taxed now, not later. But having that period where you're in this year, in 2024, and you have the option of still contributing to 2023's retirement account, you do have that option. And there is also a savers credit. There's actually a retirement savers credit. If you're over a certain income threshold, you can phase out of the savers credit. But for my lower income individuals, for my people that are within that phase out amount, you are able to tap into that retirement credit, and that could be up to 20%. No, actually 50% of the amount that you're actually putting into the retirement plan. So that can that if you put in say $6,000, all right, that's $6,000, 20% of that is the credit. Now this is actually decreasing your tax bill dollar for dollar. So if your tax bill is $1,400 and you receive the $200 savers credit, then your tax bill just went down by $200. Now this is great because not only are you saving for your future, that money is growing and you can use it for your retirement, but you're also receiving an additional retirement credit. So definitely tap into that. Make sure that you're contributing to your retirement plan. You still have time. And for my self-employed folks, you can actually set up your SEP account, your self-employed pension plan, things like that. And then you do have that time period until April as well to contribute into the account. Now you do want to make sure you do this before you file your taxes so that it's reflected properly on your tax return. All right, the next is understanding tax credits. So I'm going to talk about how tax credits work. I kind of alluded to it earlier with kind of saying, hey, this is decreasing your tax bill dollar for dollar. So how tax credits work is when you receive a tax credit, which there are tons, and you can literally go into the IRS website, type in credits and deductions. It will list them all out for you. There's credits for energy efficient vehicles. There's the savers credit, homeowners credit, healthcare credits, dependent and family credits, education credits. Yeah, there is credits. Okay, so the cool thing about tax credits is it decreases your tax bill dollar for dollar. So I like to say it's below the line. So say the line is calculating your tax bill. The line is your actual how much you owe the IRS. Below the line is anything, all the credits and stuff that actually decreases your tax bill. So those are huge because, like I said, it's dollar for dollar. Deductions, what deductions end up doing is it just decreases your taxable income. So if I made $50,000 for the year and I had $10,000 worth of deductions, it just says, hey, I'm going to be taxed on $40,000 because $10,000 was deductions. All right, that's but credits, if I have a tax bill of $1,500 and I receive a credit of $2,000, that's why people are like, oh, the dependent care credit, those credits, some of those are refundable credits, meaning after your tax bill, you can still receive the credit in your hand, or cash back in a sense. Let's say that cash back. All right. So, all right. So it's like a rebate plan. Some of them. So you have your rebate credits, which is your refundable credits. Cash back, whatever you qualify for. And then you have your non-refundable tax credits, and those only get applied to your tax bill. So if you don't have a tax bill, then you don't have that credit. You don't qualify. You don't get that credit, even though you qualify for it. So some people, they may say, "Oh, I want I put on solar panels on my house." So the solar panel credit is a non-refundable credit, meaning that I have to have a tax bill in order for that credit to actually decrease that bill. If I don't have a tax bill, then I can carry that credit into the next year for that credit specifically for the solar panel credit. All right, that's an example. So yeah, hopefully that was helpful. All right. So the next one is making sure that you report all your income. So with this reporting all your income, this is gig work, freelance, any of those. So the IRS, last year, there and the year before that, the IRS came out with a an update reporting saying, "Hey, we're going to require these companies to send everyone a 1099-K form if they received more than $600." I don't know if y'all remember that, when it was like Cash App and all that. And then hold on, yeah, I gotta get some more. Got a little dehydrated. Okay. So they said, hey, if you receive more than $600, we're going to require that you receive a 1099-K to reflect the $600 that you received. Now, the IRS amended that and they said, oh, we're not going to do the $600 thing, and they stopped it, right? But now for this year, for 2024, they said, hey, we are actually requiring if you receive more than $5,000, then you're going to receive that 1099-K form. So, and that could be through Cash App, Venmo, all those other sources. So $5,000 is your cap there. So if you see more than 5,000, you're going to get that 1099 form. All right. And also, not reporting your income can lead to penalties and interest. The IRS can now charge up to 8% interest on the tax bills. Oof. Look, yeah, it will add up very quickly. Okay. Add up very quickly. All right. Also, the next thing I'm going to talk about is making sure that you keep good records. I actually had a phone call with a client or a potential client yesterday, and they talked to me and they're like, hey, I'm with the current bookkeeper right now, and I don't know if I should continue to stay with them. They're telling me this, and one of the things that they told them was, hey, you don't have to keep these records, you don't have to keep these receipts, and it's okay. But it is crucial, it is extremely important that you actually maintain and keep records of your income, how you qualify for those credits, and how you qualify for those deductions that you actually put on your tax return. So the IRS actually identifies deductions and credits and things like that as claims. So though they say deductions and credits are claims against your tax bill, essentially. So when they're auditing you, they're saying, hey, we want you to justify these claims that you said you qualify for this credit, or that you said this deduction was for this, that, and the third. So with that, they want you to produce the information. Now, I gave her this example. If you went to Walmart, you could spend $2,000 at Walmart, easy, right? If you went to Walmart and purchased groceries, which I hope you're not spending $2,000 on groceries. But anywho, you could have did groceries, you could have went shopping in the clothing aisle, whatever. Let's say 1,000. I feel like 2,000. You spent $1,000 and you put it on your taxes. and you didn't keep the receipt because your bookkeeper and tax person said you don't have to keep the receipt, and the IRS now pulls an audit and they're trying to figure out what this $1,000 is. And you're like, oh, I didn't keep the receipt because it didn't matter. I just spent it on the business or for this. Well, you could have either spent it on groceries for your home or whatever the case may be, or you could have spent it on furniture or supplies, things like that. So that's why it's important to have an itemized receipt that's going to reflect, hey, this is what that deduction or this is what that amount was spent on. So all right, so that's why those are important. The next thing I'm going to go over is educational benefits. So for those of you that are actually enrolled in some sort of higher education, this qualifies. So you can qualify for the lifetime learning credit, and this is past the American Opportunity Credit. So the American Opportunity Credit is for the first 4 years of your like primary first like your bachelor's degree, things like that, associates, your first 4 years. And then after that, you can actually still tap into the lifetime learning credit. So these are their credits. So they do help below the line. They help with your tax bill dollar for dollar. And these are credits that people love to tap into because, especially the American Opportunity Credit. The American Opportunity Credit specifically is because it has a refundable portion, which means you get that rebate. And then it also have the non-refundable portion. So it helps decrease the tax bill on both ends, but it also allows you to get a little rebate, cash back, if you will, if you don't have a tax bill. Versus the lifetime learning credit is going to go towards your tax bill. All right. The next thing, one before last, I'm going to go over is understanding capital gains. So I kind of alluded to this last week as far as how capital gains taxes work. So capital gains taxes are like this. Capital gains are in the passive bucket. Let's say that. There's two buckets. One is passive income and then one is non-passive income. Right. So with passive income is going to be your trading accounts. Maybe you sold an investment property, that maybe you sold a business, things like that. So, and that's going to be in your passive bucket. Your non-passive bucket is going to be the money you're actually working for, like your W-2 income, your self-employment income, things like that, your gig work, freelance work, those. So that's going to be your non-passive. So now we're going back to the passive bucket. So the passive bucket is where you start calculating capital gains tax. So how capital gains tax work is you're either taxed at the ordinary rate, which is it's the ordinary rate, also called the short-term capital gains rate, which is also the normal tax rate that you're taxed with all the rest of your income. So your W-2, all that. So that short-term tax rate, it's anything that you kind of made, bought and sold within a year. So maybe you purchased an investment property and you also sold it in the same year. You're going to be taxed at the short-term capital gains rate, which is the regular tax rate, depending on what, your filing status and things like that. But for your long term, maybe you purchased an investment property this last year and you won't sell it until 2025. You're going to be taxed at the long-term capital gains rate. So, and this one it's three categories. You either tax at 0, 15, or 20%. And that depends on the amount of taxable income. And people like the long-term capital gains rate because it can be a lot lower. It is a lot lower a lot of times than your ordinary rate. So you're taxed 0% for the first, say you're filing single, for the first 44,000 of the long-term capital gains that you made. You're at a long-term capital gains rate of 0%. Next is your 15%. And then after that, you go into the 20% range. if it's more than 490,000, around there. If you're married filing jointly, then that 0% tax rate goes to 89,000. For my head of household, it's at 59,000. So that's a huge tax saving if you're looking at long-term capital gains. And this is why people, it's beneficial to hold those properties or things that you're trading or things like that for more than a year, because you don't get hit with that capital gains tax. Or you get hit with the capital gains tax at the long-term capital gains rate, I should say. Excuse me. All right, so the last thing I would like to cover with y'all today with this live is to make sure, even though I did go over 8 different things that you need to be aware of when it comes to taxes, when it comes to identifying the basics of your taxes, the big thing is to make sure that you are seeking professional advice from a knowledgeable expert, someone that you trust, somebody that's experienced, that's been in the industry, that knows what they're doing. So make sure that you're actually seeking professional advice, consulting with a tax professional, using reliable softwares as well. So these are gonna actually also make sure you subscribe to these different informational hubs to make sure that you're up to date on different benefits and laws that can help decrease your tax bill and hopefully and get you a refund as well. So making sure that you're knowledgeable on these things, making sure that you continue to tune in to Sipping Wealth Live, because I will continue to cover more topics. Make sure that you all are aware. And then these are also available on the Sipping Wealth YouTube channel as well. So make sure that you're aware, make sure that you're seeking out a knowledgeable tax professional. This is huge. This is something that you're not escaping. So the best way is to understand it to the best of your ability and to make sure that you're partnered up with a great knowledgeable professional so that you can keep that tax bill low, more money in your pocket, and wealth up. All right, so I didn't get any questions. Okay, so with that, next week I will be covering some tax myths. So I will be debunking some tax myths, some misconceptions, and I'll be providing some accurate information and practical advice so that we can avoid some costly mistakes. Okay, so that's what I'll be going over next week. Tax myths debunked. Okay, I'm super excited for it. Make sure that you are tuned in next week for Sipping Wealth Live. Thank you for tuning in to another episode, and don't forget to wealth up.